Hey everyone, this is a new series I'm starting on monopolistic companies, as I think they're a great way to learn about different companies that are dominant in their industry or have very few competitors. Before we begin, let's define what a monopoly is. So a monopoly is simply a company that has no competition or very little competition, and they have complete control over the costing structure of their product, and they can dictate price changes and create barriers for competitors to enter the marketplace. Due to the advantages a monopoly can mean a great opportunity to an investor by purchasing the company's stock. I'll start with the chocolate monopoly, which is the Hershey Company. The Hershey Company is an American multinational company and one of the largest chocolate manufacturers in the world. It also manufactures baked products such as cookies and cakes, and sells beverages like milkshakes as well as other products. The Hershey Chocolate Company was founded in 1894, and it was originally called the Lancaster Caramel Company. The company was started by Milton S. Hershey and is located in Hershey, Pennsylvania. Hershey was not the first to make milk chocolate, but he was the first to make it out of fresh milk using mass production techniques. The Swiss made milk chocolate out of powdered milk, and chocolate generally was an expensive treat for the rich. In Denver, Colorado, Milton Hershey learned how to use fresh milk to make caramels, a unique strategy he later employed at his Lancaster Caramel Company. He also wanted to use this technique for his milk chocolate. As a result of using fresh milk, he would have tastier chocolate that would stay fresh for longer than the competition. He later sold the Lancaster Caramel Company in the year 1900. But he retained the rights to the Hershey Chocolate Company and kept a small part of the factory to continue manufacturing his chocolate products. That same year, he would sell the first Hershey's milk chocolate bars for the affordable price of 2 to 10 cents. Eventually, a 5-cent bar would become the standard. Milton Hershey would continue to experiment, refine, and perfect the formula. He was extremely dedicated to this endeavor and would work day in and night out, not even leaving for meals. Good thing he had all the chocolate within reach.
The land of chocolate.
The company eventually began mass-producing milk chocolate at a price affordable to everyone and not just the wealthy. The original products were the Hershey's Milk Chocolate Bar, Milk Chocolate with Almonds Bar, and the Hershey's Kisses chocolates, which remain iconic to this day. The company went public in 1927 and was listed on the New York Stock Exchange. Along with the organic growth of the business, they also made several acquisitions as the chocolate and candy market was consolidating into fewer players. In 1963, they acquired the Reese Candy Company. In 1977, they acquired Twizzlers. In 1979, they hit $1 billion in annual sales. In 1996, they purchased Leaf Inc., which added 40 new brands to their portfolio, such as Jolly Rancher and Milk Duds. In 2008, they achieved $5 billion in sales. In 2021, they announced the acquisition of Lily Sweets, a high-growth, more health-conscious confectionery brand. In 2022, Hershey's has $10.4 billion in sales. Hershey Companies owns many strong and famous brands such as Hershey's, Kit Kat, Jolly Rancher, Rolo, Score, and many more. It's very difficult to visit the snack food aisle in any store and not have the majority, if not all of your choices for candy be from this single company. Thanks to strong branding and pricing power, the company is able to increase prices at a rate that is even higher than inflation, allowing it to pass all the incremental costs onto customers while also seeing a huge boost in sales. Due to the strong branding, you will simply pay for that Kit Kat bar rather than going for the store brand chocolate, even if it's slightly cheaper. Just imagine trying to start your own chocolate company and the difficulty you would have trying to get any shelf space from the many established brands the Hershey Company already owns. So now let's prove that the Hershey Company is a monopoly. Looking at the market share of all the chocolate companies in the United States, Hershey's is the dominant player with 33.5% market share. Its next closest competitor is Mars with 26.1% market share. But unfortunately for us investors, Mars is a privately held company and we can't buy shares of it, which is why I'm discussing the Hershey Company. Every other major player has less than 9% total market share and not even close to Hershey or Mars. Hershey is number one in the duopoly of the U.S. chocolate market. The Hershey Company is a chocolate empire that prevents new, smaller companies from gaining traction, and they can raise pricing at rates higher than inflation to continue making record profits year after year. Not good news for the consumer, but as an investor, this is exactly what I like to see in a monopolistic business. Finally, let's look at the financial metrics of the Hershey Company and see if it's a good buy in this current market. The company currently trades at $259.09 per share, which tells us absolutely nothing.
I am your father's brother's nephew's cousin's former roommate.
What's that make us?
Absolutely nothing.
The real price you pay is the market cap, which is currently at $52.958 billion. When you purchase a share of a company, just imagine you're purchasing the entire company to determine if it's a good or a bad value. We can see the revenue has grown slow and steady from 2015 to 2022 without a single down year. Even during 2020 and 2021, the company still showed growth, which shows its predictable and stable nature. This business is very defensive. We can also see the share count decrease over time as the company continues to create value for shareholders by giving existing shareholders more ownership of the company without investing anything further. The company pays a dividend of $4.14, which is a 1.59% starting yield. The most important thing about a dividend is its payout ratio, which I like to calculate using the company's free cash flow. You want this ratio to be under 50% as a general rule of thumb. Anything higher, with the exception of REITs or other income-focused funds, could be unsustainable and could lead to a dividend cut or cancellation, which is what we want to avoid, as it not only means our cash flow is at risk, but the stock price will follow. In the last 12 months, Hershey's generated $1.8 billion in free cash flow, and they paid $775 million in dividends, which means they have a 43% payout ratio. And due to the stability of the operating cash flow and the capital expenditures, I would rank this dividend as extremely safe and dependable. Another important factor for a dividend is the growth rate of the dividend, and for Hershey, we can see that the 5-year average growth rate for the dividend is 8.27%, which means if we bought the company today and held the shares for 5 years, our yield on cost, assuming the same 8.27% compounded annual growth rate, would mean we get a yield on cost of 2.37%. And if we wait 10 years, then our shares will yield 3.52%. That's not very exciting, and when I have a stock with a very low starting yield, then I aim for 15% or higher dividend growth rate. That being said, Hershey's also has capital appreciation, and over the past 5 years, the stock has gone from $94 a share to $259.09, which is about 177% return, just based on the share price alone, not including dividends. That being said, past results don't guarantee future performance. And just like you can't drive a car while looking in the rearview mirror the entire time, you shouldn't invest the same way either. Now let's try and value the Hershey stock and see if it's worth buying today. Let's start by using dividend yield theory, which states that a stock will sometimes have a higher or lower yield, but will always revert to the mean and reach an average yield. This only works for companies which are stable and predictable, which Hershey's is, so I find it's applicable here. Hershey's 5-year average dividend yield is 1.94%, which is nearly 20% above the current yield, which could suggest that the stock is 20% overvalued, which means we should have a price target of around $210 to get the average yield and fair price for this stock. The other method which I like to use to find the intrinsic value of a stock is by using a discounted cash flow model. I'll be doing a 5-year analysis, as I find doing 10 or 20 years is far too difficult to be accurate, but the more predictable the business is, the more accurate you'll be. So to calculate Hershey's free cash flow, we simply try to estimate their free cash flows over the next 5 years and then discount those values back to today by our discount rate to tell us what we should pay for the stock. So I'm just going to share my assumptions for the company. So for the revenue growth, on the low end, we're going to guess 5%. And then on the high end, which is just what analysts are estimating, we're going to estimate a 9% growth rate. For the free cash flow, I'm going to just estimate that they convert about 17% of their free cash flow from their revenue, which they've done consistently over many, many years. So I'm very comfortable using that number. We're going to be doing just a 5-year valuation. So only 5 years of revenues and discounting back to today to determine the free cash flow of the company. And then a price to free cash flow of 25 on the high end and then a 20 on the low end, as that seems to be pretty normal for this stock and it usually trades a little expensive anyway. And if we want a 13% rate of return, I calculate that the stock has an intrinsic value of $185. If we want a 12% rate of return, So just a 12% discount rate. We can expect $193 to be a fair price to pay for the stock. If we want an 11% rate of return, then we should pay $201. And then if we just want a 10% rate of return, we should pay $210, which, funny enough, is the exact same number we got for the relative dividend theory, which would suggest that that is simply the fair intrinsic value of the stock. So it appears that the Hershey company is trading a little expensive in the market today, as it currently trades for $259. And I'm calculating that for the fair relative dividend, you should be paying about $210. And if you want just a 10% rate of return, then $210 would be a fair price for the stock using a discounted cash flow model. So according to the valuation models that I've used, it seems that the Hershey company is overpriced by 23%, and it is not a buy currently. Please leave a like and subscribe to the channel if you enjoyed this video. And if you also want to follow me on my channel, I also share my personal investment portfolio every 2 weeks. Every time I make a buy or a sell or there's major news with it, I make an update. And I'm going to be continuing this Monopoly series. So do let me know in the comments below if you want me to cover a company that you consider to be a monopoly, and I'll look over the history of it and then do a valuation model. And also let me know in the comments below which parts of the video you like and you want me to focus on, if you want me to have a little bit more on the history of the company, or if you want me to get more technical, go into the financials more, or spend more time, or just do a valuation. Let me know what you'd like me to do with this Monopoly series going forward. All right, have a great day, everybody.